Happy New Year, everybody. I am Kevin Clark. I am the CEO and the co-founder of Plant Confidence Corporation, and I just want to do a quick 2021 review with you. So some news and updates here. U.S. inflation, as we all know, reached a 40-year high last year as we had ships literally stuck out at sea with the supply chain issues. I've got a simple solution. Buy American. Don't need ships at sea. All right. Also, we had the historically low mortgage rates, which actually help propel the housing market. If you haven't looked at your home value in a while, go ahead and do so. You might be surprised. Both the number of residential sales and property values literally escalated last year. I know personally, my house in Illinois is worth way more than I thought it would be, and quite some time. Energy prices, if you've been to the gas pump, they've come down recently, but they rose nearly 50% year over year. Crude oil actually got up to about $80 a barrel before it came down a little bit, and that's the highest it's been since 2014, which unfortunately is a regressive tax on lower income people as more of their money goes into their gas tank. However, some of this was muted by the work at home movement with COVID, and a lot of us still working from home or not commuting every day to an office. Now, this is kind of cool. In my opinion, we saw an influx of day traders taking their stimulus checks and opening up a Robinhood account or such, and then going after the institutional money, the hedge fund money, meme trades, if you will, with AMC and some of the things kind of manipulated the kids sitting in their sofa in their parents' basement saying, hey, we're going to blow out the short sellers, people that expected the stock to go down by pushing the stock way higher and blew it out. And it worked for a while. So David v. Goliath worked until it didn't work anymore. But it was the first time we saw that in history, showing that the masses with a little bit of money, but a lot of numbers behind them could actually move the markets versus just the institutional and the hedge fund money, which are normally moving the markets itself. So that was eye-opening for especially nerds like us in the investment advisory business. And then COVID, obviously we spent the year with COVID, increasing numbers. The stock market generally, they all prospered. So each benchmark posting year over year gains, all of the market sectors, the stock market sectors in 2021 actually were positive for the year. Which leads us to the market update. The Dow Jones was up almost 19% in 2021. The NASDAQ was up over 21%. The S&P actually beat the NASDAQ for the first time in quite some time. It was up almost 27%. The Russell small cap stocks, normally, which have a lot more volatility, a lot more market potential, we're only up 14%. So we kind of saw a unique year. Value style investing versus growth actually far outperformed the growth style investing. We haven't seen that in a while either. So we saw a lot of things in the stock market that we haven't seen in quite some time. Now we got a new president. We have high inflation. The Fed did nothing to interest rates last year, but signaled this year in 2022 that they're looking for at least 3 hikes, which has kind of brought volatility into the market this week. They also said they're going to stop or start their tapering process, which means in layman's terms, the Fed has been buying about $120 billion worth of bonds each and every month, propping up the bond market. Mostly a lot of the government bonds are being bought by government money, and it's a shell game, if you will. They're going to stop that taper. They're going to start tapering. I believe they said this month they're going to go down to about 80 billion and buy less and less before they start doing the interest rate hikes. So that's brought in some volatility. One of the things we know, if they start raising interest rates this year, whether it's needed because of high inflation or because they're trying to get themselves more dry powder for the next crisis, it wreaks havoc on bonds. So the old rule of thumb is for every 1% increase in the interest rates, a long-term bond's going to lose 10% of its value. So just know that bonds this year, as well as stock market, they're probably going to see a lot of volatility that we haven't seen in a lot of time. And the stock market's also under pressure because even though we had double-digit returns, it was really only made up of a few names. There was a lot of companies in there that were posting, 52-week lows. But because of the way that the indices are, a few major names propped the whole market up, so positive returns were there. As well as it's the second year of a presidential cycle, a mid-cycle with midterm elections coming up here shortly. We're going to see more volatility coming into this year. We started to see it at the end of 2021. It's going to be coming into this year. That's normal. We've got plans for it, whether it be through our strategic allocation or through our tactical side. But just know that I am fully expecting a lot more volatility in 2022 than we've seen in quite some time. All right. One of the things I want to say too is if we know the S&P 500 was up 27%, and then you start looking at your year-end statements going, hey man, I'm only up 15 or 20%, and then you start going, oh man, what's going on? I kind of need to scale it back and make a real simple presentation. If you're investing and you're not 100% invested in the market, you shouldn't expect a 27% return. So don't compare your returns to the stock market returns unless you were 100% all of your money was in the stock market. So if that's the case, then, here's this. I want to use this as a little rule of thumb, if you will, a guide to kind of have you compare where you're at to see if you're doing well or if you should be making changes. So obviously it's pretty easy. Hey man, if you were 100% invested and you got 27% or better, you've done exactly what you were supposed to do. Now, if you were 100% equity and you only got a 15% return, something went wrong. Maybe you had too much in emerging markets or some foreign stocks or something that weren't doing well. A lot of investors consider themselves moderate. We don't have any that are super conservative or super aggressive, so we fall in that moderate bucket. Traditionally, it's what we call 60-40 split. 60% should be in the stock market, 40% in the bond market. So if you look at that 27% return and you're a moderate investor, you should expect a return somewhere around 16%. So take a look at your year-end statements, after all your fees and everything expenses that were done, are you hovering around these averages? If you're conservative, which is about 30% in the market, you should have an 8% return. If you're trying to generate income to live off of, you should have about a 4% rate of return last year. So take a look at those. Use this as kind of a guide. This isn't, a mantra. It's not set in stone, but take a look. Hey, did I do 16% or better after all my fees as a moderate investor? If not, have a conversation with your advisor or contact us to adjust models or what we have to do in order to figure out why you're not getting the returns that you should have. Sometimes there's some easy fixes. Sometimes there's nothing we could do, especially if it's the 401k and your employer chose your investment options. We're obviously limited by what they have chosen for you. And finally, on a little nerd alert here, I'm going to ask a little trivia question. To kind of test your knowledge. GM, General Motors, was the best-selling car company in the United States every single year from 1931 until 2020. Last year, for the first time, what car company broke its streak? The answer is Toyota. Toyota, for the first time, sold more cars than GM in 2021. So use that little tidbit at your next cocktail party. If there's anything I can help you with, let me know. Kevin Clark, known as Cousin Kevin as well. Have a happy new year. I wish you peace, prosperity, and most of all, health. So with that, I'm signing off. Until next month when we talk to you again, peace.